to buy a business. That's exactly what we're going to dive into during today's training. I'm going to reveal to you, like 10 different ways that you're able to access the money you need to actually buy a business. We're going to talk about SBA loans. We're going to talk about how to use SBA loans to be able to purchase the business you want to purchase with really good terms with little money down. We're going to talk about how to, instead of putting the money down out of your pocket, tap into other assets of the business and use those assets to get the money you need to actually cover the down payment. We're going to talk about seller financing. We're going to talk about a bunch of different ways that are creative that a lot of business owners think nothing about to tap into other ways to get financing, whether it be traditional lenders, conventional lenders. We're going to talk about that. We're going to talk about a lot of other funding options that are based on collateral or assets your business, the business you're buying, the person you're buying the business from, or somebody else may have, and being able to use those to be able to buy a business. Look, by the end of this training, you're going to have the most comprehensive guide to being able to get money to buy a business. We've got a lot of stuff to cover, so let's dive in. So a lot of different loans and options are available to buy a business. Some of these we'll talk about today. We'll talk about all of these today and many others, including collateral-based loans where you can use assets to get the money you need really cheap. Maybe you have the assets, maybe you don't. We're going to talk about other ways you could tap into assets that aren't yours to do this. We're talking about guarantor loans. Maybe you don't want to sign as a guarantor. We're talking about loans you could actually get where you don't have to be the actual guarantor, and who else could work as a guarantor. We're talking about SBA loans, 7A, 504, differences depending on what you want to buy. There's 9 different kinds of 7A loans, and you've got to have the right one for the right purpose. If you're going to get an SBA loan, we're going to talk about that as well. And we're going to talk about funding from a lot of different alternative lenders that most business owners know nothing about. Ways you could tap in to other assets from stocks, bonds, 401ks, IRAs, inventory, equipment, real estate that you may have, the business owner you're buying from, or the business you're buying from may have. And we're also going to talk about ways that if you have no collateral, you could still tap into financing using your credit, somebody else's credit. We're even going to talk about things like home equity lines of credit, which are also commonly used for business owners that are looking to buy business owners. So, knowing which option works for you is based on a number of different factors we're going to talk about today. But here's the reality. Usually one of them is not going to work for you. I always say that the smart way to get capital is to combine capital from multiple different sources. I see a lot of business owners that try to get one big credit line for $1 million, not realizing that it's 10 times easier to get credit lines of $250,000 from 4 sources than one for $1 million from one source. So really the best way to get money is to piece together the money. And that's exactly the same here. We'll talk about how to get a high amount of the money you need from SBA, but what about the difference? What if you don't want that to come out of your pocket? Well, then that's when we look at creative ways to get the down payment from other different types of financing that may work. So oftentimes it's not a funding program that will work. It is what combination of creative funding sources that we're going to talk about today you can use to be able to get to your end goal, which is actually purchasing the business. So first of all, let's talk about traditional loans. These are from traditional banks, from conventional banks. It's your Bank of America, your Chase, your Wells Fargo. It's the big banks of the world. And one of the things to keep in mind is, you need to be solid on your end credit-wise in order to qualify. Now, typically, you need collateral, you need cash flow, you need credit, but you're buying a business here. So when you're buying a business, the business needs the assets, the business needs the cash flow. In your case, in order for you to qualify for these kind of loans, you need to have a strong personal credit score. If you don't have that, we're going to talk about a way around that here in just a matter of minutes. But it is the one thing that you will need is you or somebody else with a strong credit profile to get these kind of loans. But we're also going down here the path of what's most common and what's one of the best funding options for looking to buy a business. And Michael, thanks. Good morning from coming in from Facebook. Rob says, need $500K to buy another security company. We're going to talk about how to do that today. And Michael says, have a holding company. How do I do that? Have a holding company. We'll talk about that as well, because holding companies or multi-purpose vehicle companies are very common when it comes to business acquisition. Lydia says, I just got involved with Credit Suite yesterday. I'm so excited. I'm excited to have you. Thanks for joining us. I'm glad to have you as part of our family. So traditional banks, again, are loans from when we're talking about the big banks. Now, these might be collateral-based loans, SBA loans, guarantor loans. We'll talk about all 3 of these. And basically, collateral-based loans of these 3 are secured by some kind of asset that you own or maybe somebody else owns. Okay. Personal credit doesn't matter when it comes to collateral-based loans. Cash flow doesn't matter when it comes to collateral-based loans. All that's needed is some kind of asset that could serve as collateral. I love collateral-based loans. It's some of my favorite kind of financing because, first of all, when we talk about business funding that's available for any purpose, let alone even just the purchase of a business, this gives you the lowest interest rates of everything. You can literally get 1, 2, 3, 4, 5% interest rates, regardless of how bad your credit may be with this kind of funding. So that's one of the reasons I love it. And it's also the most diverse. There's more funding programs in this category of lending than all others combined, because there's so many assets that can serve as collateral. Like maybe it's commercial vehicles or irregular vehicles or residential homes, or maybe it's stocks or bonds or 401ks or IRAs or equipment or inventory, or account receivables. There's so many assets that can serve as collateral-based loans, and you can get approved regardless of how good or bad your credit may be. Your credit doesn't matter, and cash flow doesn't matter. Now, another kind of financing here is guarantor loans, and these are loans where somebody else signs as the guarantor instead of you. So why does this matter? Well, I have a couple partners that I work with, and we buy online education and we buy online certification companies. That's what we do. So I have a lot of experience in this because for a couple of reasons. First of all, I work with the biggest people in the country that do this thing, that go out and help business owners to help their tribe buy businesses. Okay, so people like Roland Frazier, for example, is huge in this space. I'm the one that handles the funding for all of his students, for all of his actual clients. So I know a lot about getting money to acquire businesses because I help literally thousands and thousands of people through the process to do so. And I'm also an investor myself. I invest in online education and online certification companies. And I can tell you the nice thing here is that, we've got people that is the money guy, where all he's got is other business that churns off money. He needs to take that money and put it other places. So he's the money guy. And then we've got an operations guy, and I'm like the marketing head. So there's a lot of people that might want to do this with you that have good credit when you don't. Maybe they have assets available that you don't. Maybe they have some of the things we're going to talk about today and you don't. And that's okay. That's the nice thing about working with partners through a program, is that you have a strength, they have a strength, somebody else has a strength. And in this case, maybe your strength isn't credit. Maybe somebody else's strength is credit. So a guarantor loan is when somebody else signs as the actual guarantor. Now, again, that could be somebody else. It's somebody else other than you. It's an investor, it's a family member, it's a friend. It's somebody that maybe wants a rate of return. Now, when we look at this, we might say, I don't want to ask somebody for help. You're not. You're not asking them for help. You're giving them an opportunity to get in on something, right? So if I think I'm going to buy a business and I'm going to keep it for 3 years and sell it for a 50% increase in profit, well, somebody else in this world was willing to let me to come in as a signer, get their 5-10% return on that money and not have to do the work. They're just coming in as a signer. That's their part of the transaction. So there's plenty of this out there, whether you're looking to invest in real estate, buy a business, whatever it may be. There's plenty of people that want to get a rate of return on what you're doing, but they don't want to do the physical work. And those people can easily come in and sign as a guarantor to get guarantor loans. And then, of course, there's SBA loans. And SBA loans we're going to spend some time with because this is the best way to buy a business, period. It's what these things are partially designed for. SBA 7A loans. So we're going to talk a little bit about that. John, thanks for coming in from New Orleans. Polo, hello. Thanks for coming in. Pippi, thanks for coming in. And Polo is coming in from New York. So thanks for tuning in from Facebook and from YouTube, everybody. And LinkedIn's in the house as well. So SBA, let's talk about SBA. SBA does not issue loans. They guarantee loans. So what that means is it means a Bank of America gives you an SBA loan, then SBA guarantees that loan in case of default. So if you get a $100,000 loan from Bank of America, that's an SBA loan. SBA, let's say, guarantees 85% of that loan. Then if you ever default on that $100,000 loan, instead of Bank of America being out $100,000, SBA would give them 85% of it. In this example, they give Bank of America $85,000. So as a result of that, it allows these big traditional banks, Bank of America, Chase, Wells Fargo, Regions, et cetera, to be able to lend to small businesses, because lending to small businesses is inherently risky because a lot of businesses fail. Big banks are government insured, so they can't really, partake in risky investments and risky lending. So SBA offsets that risk and makes it practical and convenient for the big banks to want to give us money. So that's what SBA's role is in the process. Now, just so you know, SBA founded, I think, 1953. That's not their sole purpose. Their purpose is to support small business owners, support us. but helping us get capital is one of the many things that SBA does. Let me clarify that as well. Okay, so they have two main kind of programs you're going to care about. They have micro loans as the third. We're not talking about that today because they're not really good for the purpose of buying a business. They have 7A and 504 programs, both of which we're going to break down today. So 7A loans are available up to $5 million. So that's how much money you can get for the acquisition of a business. Okay, and they're offered through banks, credit unions, other specialized institutions. Through COVID-19, when PPP loans came out, SBA radically expanded the amount of people that can now offer SBA loans. So we now see a lot of fintech or online lenders that are now offering these kind of SBA loans. Of the three main types of SBA loans, this is the most common, 7A. And 7A is like working capital. You could use the money for a lot of reasons: marketing, growth, expansion, and for acquisition of businesses. So this is the most common loan that you're going to see used when it comes to buying a business. And SBA has 9 categories of these loans. They have what's called a standard 7A loan, which goes up to $5 million. They have what's called a small 7A, which goes up to $350,000, easier and faster to get than the standard loan. They have what's called an express loan. Again, a ceiling of $350,000, but you can get an approval in only 72 hours. They have loans that are called through their preferred sources. So SBA has preferred lenders that they give the lender more autonomy and authority to underwrite the file without SBA. So the process is easier and faster through those preferred lenders. They have one that deals with international, if you're dealing with business international, and they have 2 loans that deal with importing and exporting businesses. And then the 9th category is what are called cap lines, and cap lines are their credit lines. So all of that being said, you're going to want to kind of choose the best 7A loan, or I'll talk to you about how to get a funding broker to help you with this, to choose the best one. The best one kind of depends on, like, are you dealing with international, exporting, or importing? If not, that eliminates a third of them. And then how much money do you need? If you need $5 million, well, that eliminates a couple of them. And they've got one for veterans as well. Are you a veteran? So all these things kind of determine which one of the programs works better. A loan or a credit line is the next choice, whether you want a loan or a credit line from them. So you're typically going to need a good credit score, 680, 700 FICO score in order to get approved. You're going to need to have clean credit per SBA. You want to remove any blemishes on your credit report. To me, when they say remove blemishes, they're saying even minor negative things or things you probably want to get addressed and get removed. They'll do as little as 10% down, commonly 15% down. I'm going to teach you how to get the 10 or 15% that they require from another source instead of coming out of your pocket. And they're going to want to see 2 to 3 years worth of tax returns from the business you're buying. And they're also going to want to see that you have the experience needed to run the business. Okay, this is why SBA always asks for resumes on their loans, because they want to know you have the experience to run the business. So let's look at this. They're going to, first of all, also want the business to supply assets that offset the amount of money you're borrowing. So typically, to get approved, you're going to need to have good personal credit or a guarantor that does. We talked about that earlier. The business you're buying is going to need to have 2 to 3 years worth of tax returns that show, hopefully, that the business is, consistent or growing, not declining, right? And then they're going to want some kind of assets in the business to be used to offset the actual loan. Most common asset for 7A loans and for acquisitions are what's called account receivables, AR. And what AR is you let your customers pay you on terms. You sell them something. They owe you money. They pay you over 7 months. That's the outstanding money they owe you, is called account receivables. And that typically is the primary asset that's used to qualify for SBA loans. So I'm telling you all this for a lot of reasons, because it helps you figure out the right business to buy. People ask me that all the time. What kind of business should I buy? And my answer is always the same. The one that has the most assets. If you find a business that has the most assets, inventory, equipment, account receivables, that's going to make it easier for you to be able to get the funding you need. And the easier it is for you to get more funding, the more money you can give to the seller, and the more inclined they are to go with you versus other sellers, because they want to walk away with as much cash as they possibly can. Now, we're going to talk about seller financing and these kind of things as well, but I'm just kind of giving you a rundown of the land of how this really works. So with SBA, you want to really look at a business that has assets, that has 2 to 3 years worth of financials. Those are going to be the things that are going to be needed. Very different, right? If you get an SBA loan for your business, you need to have good credit, collateral, or cash flow. But in this scenario, you need to have good credit. It's the business you're buying that needs to verify the cash flow per tax returns and have that asset to offset the actual lender's risk. Hey, hello, Courtney from Dallas, Texas. Thanks coming in. And you're saying, please save this recording. They're all saved, Jonathan. You're watching on YouTube. You can watch it in its entirety on YouTube later. LA, California. Mark, thanks for coming in. Mark says, do you guys have a webinar for your affiliate program? We don't have one on the affiliate program, but you can get set up for the affiliate program at creditsuite.com/affiliate. Creditsuite.com/affiliate. And it's interesting you say that because I actually am going to solicit our team to do that next month. I don't even know when we've done a webinar for partners and affiliates. We do have webinars for partners on our YouTube channel, youtube.com/Credit Suite. So the next most common kind of SBA loans are called 504 loans, 10 to 20 years, loans up to $50 million. But here's what you need to care about with 504 loans. 504 loans have a specific purpose. And the specific purpose is for the buying of fixed assets. So 7A SBA loans used for anything, right? Buy a business. 504 loans used to buy or refinance a fixed asset. What's a fixed asset? Machinery, equipment. For example, is most common. Real estate is common for SBA 504 loans. It also could be parking lots. It could be utilities. It could be pavement. Okay. But the most common kind of assets that 504 loans are used for is real estate. Most people use SBA 504 loans to buy and refinance commercial real estate. And it's also second most commonly used for actual equipment, for machinery and equipment. I mentioned many other kind of fixed assets that could work, but those are the most common fixed assets, real estate and machinery. So the reason I introduced this to you when we talk about buying a business is that you might need this to purchase the real estate. You might need this to purchase the equipment or the other physical assets of the business. So let's talk about this. A lot of times nowadays, when you buy a business, you no longer buy a business. You buy the assets of the business. We call this an asset sale. So when you buy a business, there's two main ways to buy. You could do what's called a stock sale, which is where you're buying the business itself, or you could do an asset sale where you're buying the assets of the business. Now, most commonly as a buyer, you're going to go with an asset sale. That's what's most common nowadays. It's what buyers want. Here's why. Because if I buy your entire business, right? If I buy somebody's business, I buy the liability from that business. Let's say you're about to get sued and I don't know that as the buyer. Now that there's a looming lawsuit out there. Let's say there's judgments. Let's say there's taxes of millions of dollars or hundreds of thousands of dollars that's owned. The minute I buy that business, I absorb all that liability, potential tax debt, potential lawsuits, judgments, any of that stuff I don't catch, I'm on the hook for. I'm the new buyer. So this happens so much that nowadays buyers are like, I'm not buying the business. I'm buying the assets of the business. Therefore, I'll set up a new business entity, move all the assets there. And that way, like judgments and lawsuits and bankruptcy or judgments and lawsuits and tax liens and all the other stuff that could be coming, it doesn't even affect me because I have a new entity set up with the assets of the business. So again, now you kind of get an idea why 504 loans might work, because you're actually using them to buy fixed assets. And the reality is most business sales now are asset sales. You're buying assets. You're not buying the actual business itself because of those liability reasons. So let's talk about alternative lenders. A lot of different ways you could tap into alternative lenders to get money. And nowadays, 97% of all business loans come from these guys. They don't come from big banks like Bank of America and Chase and the traditional banks. They come from peer-to-peer lenders. They come from fintech, online lenders. They come from online marketplaces. These type of sources are more lenient than SBA. They allow you to have lower credit scores. They don't require as much collateral typically to be used. And they're a little bit more lenient on cash flow as well. They don't sometimes need to see years and years of tax returns. So they are looking at things like your revenue, how you manage your bank account, your time in business, and more. But what I find with alternative lenders is they tend to care more about bank statement management or bank account management, while traditional banks care more about tax returns. And what I mean by that is alternative lenders are more common sense lenders. That they look at things, do things make sense? And they know things make sense if you manage a bank account responsibly. If you're buying a business where that business has really what we call clean banks, And by clean banks, I mean no non-sufficient funds, cash flow in the bank account, a healthy business. The account's not being overdrawn. There's money left at the end of each month. There's more money going in than going out. Then that really is very attractive to alternative lenders. So, this is another way to get money outside of the big banks. So Lending Club, Prosper, they work, for example, in peer-to-peer lending, but there's a lot of other sources that we're familiar with here as well. Seed, Seed Capital, there's On Deck, there's Cabbage in the past. They just got bought by American Express, but you get the idea. These are a lot of these fintech alternative online lenders. It's easier to get approved. They can go 300, 400, 500,000 sometimes in some cases, lower credit score requirements. Sometimes you can go through private investors that are alternative lenders, and you can still get money even in the millions of dollars, but it's more expensive than what you're going to get from the big banks. So you got to be careful. You don't want predatory lenders here, or you don't want loan programs that don't make sense for acquisition of buying businesses. Cash flow financing, merchant cash advances, very popular ways to get money for business owners. It's fast, easy money, but the terms are 3 years, 4 years, 5 years. You got to pay that money back. The interest rates are 8, 9, 10, 20, 30, 40, 50%. That's not the kind of money you use to buy a business. That's the kind of money you use to deploy a marketing campaign you're going to get a quick return on investment from. So again, you got to stay away from the higher cost money, shorter term money, but there is a lot of other alternative financing out there that can work. So when we talk about assets that can work, one of the biggest ones we look at is 401ks and IRAs. So if you have a 401k or IRA, if a potential investor that wants to invest into this endeavor has a 401k or IRA, you can use those to get money as well. Usually the basic requirements are that you have like $25,000 in value in the 401k, and you can borrow as much as 100% of the value of the 401k. And it's based on IRS proven strategy. So it doesn't cost you any money in penalties to actually borrow against the 401k. So this is a great way to get money for the purpose of buying a business. There's no credit requirements. There's no cash flow requirements. You just need to have the 401k, and you can borrow as much as 100% of the 401k. 25,000 is the minimum. They like to see you have about 35,000 in value from the 401k. Now, beyond the 401k and IRA, we look at stocks and bonds. Stocks and bonds are even better because you don't even have to sell them or anything. You could still borrow against stocks and bonds that are invested other places and borrow as much as 90% of those. And with 401k, stocks, bonds, IRA financing, you get interest rates as low as 5%, and you could choose loans and or credit lines. So what I like about this is that in a lot of cases, when you get in the business of buying businesses, as I mentioned, they're very, very smart, wealthier people that have money that want to invest but don't want to do the work. Well, these people have stocks, they have bonds, they have 401ks, they have IRAs. So again, even if you don't have those assets, it's very common to find people that want to be part of this business building process, get a rate of return without doing the work. Their contribution is letting you use the asset to borrow against. And again, what I like about securities financing, stocks and bonds, is just think about this for a second. You don't have to liquidate them. You don't have to sell the stocks and bonds. You still earn the interest on the stocks and bonds, but you leverage the money for another purpose. It is, to me, the definition of double dipping. I have money invested in the stock market. It's earning me a rate of return. Then I leverage those that are already earning me interest, and I get a credit line that I can then use for another purpose. And this one, acquiring another asset, the business itself, that's going to generate me a rate of return. So I've got money in the stock market that's earning me a rate of return. Then I leverage that asset, the stocks itself, to actually get a credit line to then take another asset that can earn me rate of return. It's brilliant. So if you don't have stocks and bonds, you want to think about somebody else that might have stocks, bonds, 401ks, or IRAs. Really smart ways to do it. Now, seller financing is very common, and you're almost always going to have it. You want to have it because as a buyer, like the seller needs to still have something else left that they are getting back when they walk away from the business. I mean, so they have some kind of interest in making sure the business succeeds when they're gone. You don't want an owner that sells you a business and then has nothing else on the hook or on the line, and they could just walk away and the business could fail. And there's all kinds of things that could have been done to sabotage the business that you didn't know about, or that things that are negative that you didn't look at and due diligence. And all of a sudden the business fails in a short period of time. You don't want that to happen. So the seller still having skin in the game really goes a long way to giving a buyer peace of mind that the seller's going to sell to you and then everything's going to pretty much go okay, because the seller still has money on the line. And it's very common for that reason. And it's also common because a lot of buyers have a hard time getting all the money they need to buy the business. So SBA might come in and give you 85% of the money you need to buy the business, and the seller may finance the rest, for example. They might do a seller-held financing for the other 15% for a year, 3 years, 5 years, 10 years, 15 years, and the terms vary. It's your decision and the seller's decision on what kind of terms you actually come up with, okay? So that could bridge the gap between you getting other money. It could also be a way for long-term for the seller to continue to get, money every single month well after the actual business is sold. And again, there's usually up to a 30% down payment in some types of transactions for SBA. Maybe they'll do 15% down, 10% down. Maybe they want 30% down. So again, working with the seller, doing seller financing is something that's very common in buying businesses. And nowadays, when you look at businesses for sale on places that sell businesses online, you'll find that a lot of them even advertise that the seller is willing to do financing as part of the business and what percentage of financing they're even willing to do. Okay. So sometimes this can cover your down payment. And again, it's usually a smaller loan from the seller. But the nice thing here is that SBA could come in and do 80, 85% financing. The seller could do the difference, or maybe it's flipped. Maybe the seller does 50, 60, 70, 80, 90% financing, which sometimes happens. I've seen business owners do 100% financing on the business they sell. And then maybe they do 85% financing and you get the financing for the rest that they don't finance. So seller financing, very popular. They might be able to cover the small amount you need down from an SBA loan, or they may be able to replace an SBA loan and be able to finance the majority of it and have a smaller amount that you're getting money from elsewhere. I found when it comes to buy businesses, the more money you're willing to give the seller, the more inclined they are to go with you as a buyer. So seller financing works, but I would use it for a minimum amount that you need, not for a large amount, or you really jeopardize losing the actual seller. Are you getting value? Do me a favor. If you're getting value, hit the like button, hit the love button, hit the share button. Give me some love. So that way I know I'm on the right track and we can get this exposed to more entrepreneurs as well. And John says, I love the education. Thanks, Paul. Appreciate it. And John says, where did you go, John? Hey, Ty, I can't believe I was approved for Uline and Murphy USA in the same day. Unbelievable. Awesome, man. Congratulations. Oh, I'm glad to see you're building your business credit. Good day, Michael. Thanks for coming in. Owner Hollister Productions. Hello. Great content from Dallas. Thanks for coming in. Mark, leverage and buy cash flow real estate assets. Yes, very smart. John, people who have money who don't want to do the work but want to invest. Wow, even more ways for funding. Yes, and that's very true. And what's interesting is that I talk to a lot of real estate investors. Real estate investors is one of the top 5 segments that we help get money. And what we find is that they go to places like Meetup. And when they go to these meetups, they find these people all day long that have money but don't want to do the work, and they join with them. And so you just have to keep that in mind, that there are plenty of people in this world that have money and are looking to put that money places where they get a rate of return without doing the physical work. And as we just mentioned, as John just mentioned, it's a really good place to tap in and get money. So credit line hybrid is a way you can leverage your credit or somebody else's credit to get up to $150,000 in funding. What I like about this is it's no doc. You don't need tax returns. You don't need bank statements. And you get 0% financing for 6 to 18 months. So you get 0% for 6 to 18 months, which gives you time to get the business generating even more money to be able to pay down that 150 grand. So if you don't need a tremendous amount of money, hundreds of thousands or millions, or you got most of your money from SBA, you just need another 50, 100, 150,000. This could be a really good program to go with. You do need to have good personal credit to qualify, 680 plus FICO score, low inquiries, low utilization in order to get approved. But you can use somebody else as a guarantor in order to get the money you need. And it's no doc. It's just really fast, easy way to be able to get money without verifying cash flow or collateral. Home equity line of credit, you can get these as well. 620, 650 scores. A lot of lenders want to see you have better scores. Typically, you're going to need to have at least 20% equity in your home. Most lenders are only going to give you 80, 90% total loan to value. So if you have 20% equity in your home, you might be able to get another 10% through a home equity line of credit. But leveraging a HELOC or a home equity line of credit to get your money as well makes a lot of sense as well. So let's talk about a lot of stuff that isn't here that probably should be here, okay? If you're buying an insurance agency or an insurance business, There's a great program where you can actually use the renewable commissions from the insurance agency itself as collateral to buy the business. And that's typically going to be enough for you to get all or most of the money down that you need. So you leverage their renewable commissions and use that as the collateral to actually buy the business. A very effective way to be able to buy businesses. Let's also not forget about all the other assets a business could have that you could tap into. A business could have equipment. They could have machinery. Okay. They could have inventory. Well, like how much do they have in inventory? Any of that could be leveraged. So there's something called equipment sale leaseback where you could borrow against equipment a business already owns. So I think about my buddy Chip, and he owns a huge factory that's a plastics manufacturing facility. It's insane. I mean, I don't know how many millions and millions he has in equipment, but when you walk into his facility, it's really impressive. There's two things you see. You see a lot of equipment lining the outside wall that's worth got to be millions of dollars. Then you see these massive shelves that I don't even know how high because I'm short, but it's big all the way to the ceiling full of inventory. So if I walk into a facility like that and I'm buying it, I already know that the type of business that he has account receivables. He's letting his customers pay him on terms. I also know he's got tons of inventory. I also know that he's got a lot of machinery. All of those things can be leveraged and used to be able to get the money we need to buy the business. So for example, let's say I come in and get 80% financing from SBA, and then I have him do a 10% holdback seller carry because I want him to have some skin in the game. And then I get the other 10% by using his equipment, his inventory, or his account receivables as leverage. Well, actually, let me do a real scenario here. So let's say I want to buy that business, but I'm going to use his account receivables as collateral to get the SBA loan. I'm going to leave those alone, use that as collateral to get the SBA loan. The SBA wants 20% down, 10% is going to come from him. Okay, he's going to carry back 10%. The other 10% I leverage his equipment, right? Leverage his inventory, borrow against to get the other money that I need for the other 10% down. I'm solid. I'm set there. That's how I make the transaction work, combining a few of these different things. So stocks, bonds, 401ks, IRAs. When we look at the business, we look at the commercial real estate they may own. They have equity in the real estate, in the business, which a lot of business owners do. When I'm talking to a lot of people that are buying businesses, they're buying businesses where the equity is in the actual real estate. And then we're going in and getting an SBA 504 loan to get the money out of the real estate that can actually then be used for the acquisition of the business. So there might be equity in their vehicles that the business has. There might be equity in the actual real estate that the business actually owns. Okay, those are the most common assets: account receivables, account receivables, inventory, equipment we can borrow against. We can borrow against their equipment or their inventory and get a line of credit against the inventory that we can, again, use to be the primary funding vehicle or a secondary funding vehicle, combining these other types of financing as well. But those are the most common types: account receivables, equipment, inventory, commercial real estate. Those are the most common assets an actual business has. You can even use vehicles. I think I mentioned that. And then on the personal side, stocks, bonds, 401ks, IRAs can all be used to get financing. You can use credit line hybrid using credit as a way to get funding. We can go through the traditional banks to get SBA. We can go through alternative lenders to be able to get similar to SBA, worse terms, but easier to qualify loans for the purpose of buying and acquiring. And then we can also tap into things like home equity line of credit, as well as our stocks, our bonds, our 401ks, our IRAs, or somebody else that wants skin and that wants to actually get a rate of return. Maybe they are willing to pledge their house as collateral to get a home equity line of credit, or stocks, bonds, 401ks, or IRAs to use those kind of assets to be able to get money as well. So those are a ton. I said 10, but I think we talked about 20 plus different ways that you can get money for the purpose of acquiring a business. So we talked about collateral-based loans. We talked about guarantors. We talked about SBA loans. We also were able to talk about 401k, stocks, bonds, IRA financing. We talked about credit line hybrid. We also talked about alternative lenders that lend in this space as well. And of course, if we can help you along the way, let us know. We've got great SBA broker team that does our PPP loans, all of our clients' SBA loans. and they do a very successful job. And we have all this funding that we talked about today. Some of it we don't, peer-to-peer lending, we don't work with some of that stuff, but let's not forget crowdfunding as well. There's crowdfunding that's out there. There might even be investors around you that want to invest as angel investors into the deal as well. So those are some other ways that you can get funding. And if we can help you along the way, give us a call, 877-600-2487. As a matter of fact, you probably want to go to our funding challenge, which is funding30challenge.com. And if you do that, you will see that March 15th through the 19th of 2021, we've got a funding challenge where we're going to go over 30 different ways to get funding for your business. A lot of ways most business owners never even heard about. We're going to have angel investors there, venture capital sources. We're going to have grants that talk about how to get free money for a business. As well as 27 funding options. We're going to talk about most business owners know nothing about. 3 that we'll talk about that are pretty common. A lot of business owners know about. We're going to talk about building your fundability, building your business credit. I'm not even talking about those topics. I have people that teach me. My mentors are coming in and teaching on those topics as well. So 20 of the nation's top finance experts are going to come to this challenge March 15th through the 19th, 1 to about 3:30 in the afternoon. It's free to get in, free to register. There is a VIP option you can choose if you want the recordings or backstage access, and it all takes place in a private Facebook group. So I will not be in live. The live streaming will be happening 15th to the 19th, but I won't be the one hosting it. I'll be behind the scenes in our closed group doing the funding challenge with about 5,000 to 10,000 entrepreneurs whose primary goal is to get money to grow your business. So the challenge is to expose you to 30 different ways to get funding through 20 financial experts, and you choose the 3 that work best for you to get money in 2021. That's what our challenge is all about. The entire challenge is dedicated to pulling together a bunch of entrepreneurs with the common mission. We want to grow our business. We want to get money to do so. Bring in all the experts that focus on getting money and want to give us money, and then put the 2 together, right? People that want the money and the people that have the money. Whole purpose of the challenge is to combine these 2 people, the people that want the money and the people that have the money. And it's never been done before in our industry. We're really excited. 100% free to get in. You go to funding30challenge.com. You can see it right there, funding30challenge.com. And if you go to funding30challenge.com, you can register, get in March 15th to the 19th, and choose your favorite of 3 different options. Cash giveaways, about $500 in cash a day we're going to give away during the challenge as well, and many other cool things. So make sure you check it out, funding30challenge.com. And let me go ahead and answer any questions that you may have as well. And again, if we can help you along the way with getting money, feel free to give us a ring, 877-600-2487 on a consultation. We will talk to you about all the funding you can qualify for now. We can even get you with our funding team that helps with a lot of acquisitions of businesses. We will qualify you for business credit. We'll actually pull your business credit reports. We'll go over those with you. We can even talk to you about getting business credit reports for other businesses, something I help a lot of potential buyers do. And we can do a fundability assessment on you or the business you're looking to buy to talk to you about how fundable the business is. That consultation is 100% free with us. If you got value, we go live on Facebook, YouTube, and LinkedIn Tuesday and Thursday at 1, 11 o'clock on Wednesday. And we have hundreds of training videos on our YouTube channel on fundability, getting money, building business credit. We have daily tips on Facebook, Instagram, Twitter, as well as a podcast. You can listen on the go. About 400,000 people have downloaded that podcast. Very popular. We have experts like the guy I just interviewed. All he does is he teaches business owners how to grow organically. And all the training was about growing organically. So we have these experts come in that can help. And I want to make sure your questions are answered. But now you know the best ways to be able to acquire business, how to combine funding to be able to do it. If you want even more cool access to ways to get money, make sure you check out funding30challenge.com so you're able to tap in and join us during the challenge March 15th. Okay, Mark says, gotta love our meetup investment partners. Yes, I love Credit Line Hybrid. Yeah, it has really been a powerful program. A lot of people have benefited from. And okay, so I am going to wrap this up. I've got, I think, a couple guys that are doing some weird spamming stuff in here, so I'm not going to address them. So make sure you register funding30challenge.com. Looking forward to seeing you there. And I look forward to seeing you on our next training. We're talking about more cool ways to start and grow your business. If you got value, do me a favor, hit the like button, hit the love button, hit the share button. And also make sure you subscribe. And when you do subscribe, especially on YouTube, if you click the bell and click all, then you will be notified when we go live, and you can get more training on cool ways to be able to get the money to buy business or to grow an existing business. Thanks for tuning in.